A brand new tax bill called the Big Beautiful Bill was just signed into law. What does that actually mean for you? Lower taxes, bigger deductions, less taxes on your tips or overtime? In this video, I'll break down the top 10 changes so you know exactly how it affects your wallet, your business, and your future. Hi, I'm Greg. I'm a certified financial planner and CPA, and I created this channel to help you make smart, informed decisions on your taxes and finances. So let's dig into the top 10 changes. Number 1. Lower tax rates have been made permanent. The lower tax brackets that came into place under the 2017 Tax Cuts and Jobs Act, aka TCJA, are now permanent. The current rates of 10, 12, 22, 24, 32, 35, and 37% are sticking around for good. Without this bill, rates would have increased across the board, with the top marginal tax bracket going up to 39.6% in 2026. Lower rates help taxpayers across the income spectrum pay less in taxes, although taxpayers at the highest income levels tend to see greater benefit due to the lower top marginal tax rate. Number 2, the higher standard deduction continues. The higher standard deduction of $15,750 for single filers and $31,500 for married couples is now permanent. Every year, taxpayers can choose to either itemize the deductions, taking into account things like mortgage interest, property taxes, and charitable contributions, or take the standard deduction. Having a higher standard deduction means more taxpayers will choose to take the standard deduction because it will give them greater benefit, and less will itemize. Number 3 is AMT relief continues. The alternative minimum tax, or AMT, remains less of a problem for most households. AMT is a parallel tax calculation that can cause some taxpayers to pay additional taxes based on the type of income or deductions that they have. The Big Beautiful Bill extends and makes permanent the higher AMT exemption amounts. This means that fewer taxpayers will be subject to AMT because they can now exclude more of their income from the AMT calculation. Some taxpayers will still have to plan for AMT if they do things like exercising incentive stock options or have another form of AMT adjustment, but for the vast majority of taxpayers, AMT is less of an issue. This is a big change from pre-2017 tax years when AMT impacted many taxpayers in high-income tax states. Number 4 is lower mortgage interest deductions. The mortgage interest deduction cap of $750,000 is now permanent. This mortgage interest cap was temporarily reduced under TCJA from $1 million down to $750,000, but now the $750,000 cap seems to be here to stay. This is especially important for homeowners in high cost of living areas where home prices can easily top $1 million. Interest paid on mortgage balances over $750,000 won't receive any tax breaks, thus making higher mortgage payments harder to cover. Number 5, SALT deduction has been expanded, at least temporarily. From 2025 through 2029, you'll be able to deduct up to $40,000 in state and local taxes, aka SALT. State and local taxes are primarily state income taxes and property taxes paid on a personal residence. However, this higher deduction limit only applies if your income is under $500,000. Above $500,000, it starts to phase down. The higher SALT deduction comes with a marriage penalty, though. A married couple gets the same $40,000 deduction limit, income phase-out range as a single taxpayer. After 2029, the cap does return to $10,000. Number 6 is pass-through deductions continue. If you own a business, especially an LLC or an S-Corp, you can continue taking the 20% qualified business income or QBI deduction. However, if you're in a specified service trade or business, like law, medicine, consulting, or accounting, the QBI deduction phases out at higher income levels. This means that while the QBI deduction can be a great tax savings for operating type businesses, it often has little to no benefit for higher income service-based businesses. Also important to note is that the bill did not eliminate the pass-through entity tax or PTET workaround. This allows business owners to pay state income taxes through their business as a way to get around the personal SALT limitation. This workaround still exists and will allow pass-through business owners the ability to potentially deduct additional state and local tax payments from their federal income. Number 7 is the estate tax exemption has been increased. The estate tax exemption is now permanently set at $15 million starting in 2026. This amount will be indexed for inflation going forward. The estate exemption is the total amount a person can gift during their lifetime or pass to beneficiaries upon their death without incurring estate tax. At these higher levels, the estate tax won't impact many people, but this is a very big win for families with larger estates. Number 8, no tax on Social Security, kind of. People over age 65 get an extra $6,000 per year deduction. per person or $12,000 per couple, and this applies whether they itemize or take the standard deduction. These additional deductions phase out at $75,000 of income for a single person or $150,000 for married. These deductions don't fully eliminate tax on Social Security benefits, but for many seniors, it may significantly reduce the taxes that they pay on their income. Number 9 is no tax on tips. From 2025 through 2028, there's a new deduction for qualified tips of up to $25,000 per year. It's limited to occupations where tipping was common before 2025 and phases out at $150,000 for single or $300,000 for married. And lastly, number 10, no tax on overtime. There's also a deduction for qualified overtime pay of up to $12,500 for singles and $25,000 for couples. This runs from 2025 through 2028 and follows the same income phase-out limits as the tip deduction of $150,000 single and $300,000 married. This new tax bill touches on nearly every part of your financial life: your paycheck, your deductions, your business, and your legacy. Whether you benefit depends on your income, your filing status, and how you plan. As always, the best tax strategy is one that is forward-looking, proactive, and takes into account your complete tax and financial picture. If you found this breakdown helpful, please like and subscribe for more clear, practical tax and financial planning content. And please leave a comment below with any questions or topics you would like covered in future videos.